until showtime. 5 minutes until showtime. 4 minutes until showtime. 3 minutes until showtime. 2 minutes until showtime. 1 minutes until showtime. Your show will go live in 5 seconds. 4, 3, 2, 1. Blog Talk Radio.
Good evening, everyone. Welcome to the show. This is Trucking with Authority. I am your host, Kenny Long, and for the next hour, consider me your navigator on your journey to success. Here on the Trucking with Authority show, we can talk about anything from getting started in the business as a driver to becoming an owner-operator, a lease operator, to becoming a full-blown motor carrier and running freight under your own authority. We can talk about dealing with the FMCSA, understanding your numbers, insurance requirements, record-keeping requirements, you name it. If you have any questions or comments, this is the show. Bring it to us. You can call the number at the bottom of your screen, 917-889-9924. We're streaming live today on both platforms, YouTube and Facebook, simultaneously. If you're on the YouTube side, go ahead and subscribe and hit the bell. That's the best way to get alerted. We will be doing all of these on both platforms from now on. We'll also be recording the shows for playback on L&J Radio. You can find L&J Radio at lnjradio.com or on the slipping my mind what this other app is called, but lnjradio.com. So again, you can call the number at the bottom of the screen, 917-889-9924. We've got some good stuff to talk about tonight. We've got some callers online. We've got several people streaming on both platforms, it looks like. We're doing pretty good here. This is our first attempt at streaming on both platforms at the same time. We'll see how this works out and see if we can make this happen. Again, we're also recording the show tonight for playback on L&J Radio. And we're live on Blog Talk Radio, so we're trying to get as many people on board as we can. The number to call in if you have any questions or comments, because I've got so much going on, it's almost impossible for me to read all the comments from everywhere in one place. So that being said, I wasn't sure if this was the best way to do it or not, but I know that this will get more information out there. So again, the best way to ask your question or add your comments is call in to the show, 917-889-9924. Again, we've got several callers on already. We have several people watching on both streams as well. Awesome. So here we are, December 5th, 2017. 2017 is coming to an end. Over the next few weeks, we have obviously some pretty major holidays. Things are going to be crazy. We're a little out of sorts. People will be running around like chickens with their heads cut off to wrap things up for the end of the year, still deal with the holidays. All of the end of year business stuff that we have to deal with sometimes gets lost in the mix. So I want to talk about some of that stuff tonight. One of the big things that we have to think about, obviously, at the end of the year, at the end of any fiscal period, is taxes. Nobody likes to think about taxes until tax time, but guess what? In reality, it is tax time. The end of the year, for most of us, unless you're on some strange fiscal year, for most of us, the end of the year, December 31st, will be the end of the tax year for us as well. So obviously, when we start talking about end of year preparations, that's probably the first thing on everybody's list. So we have to be very aware of what we've got going on there. So, first things first, whenever you're talking about taxes, you have to talk about knowing your numbers. So pretty much every time we talk about anything, we have to talk about knowing your numbers, right? And that's what it comes down to. You need to know your costs. You need to know your profit. You need to know your losses. You need to know where you stand right now, because come December 31st, the books get closed. There's not much more you can do. You have to understand exactly where you stand so that going forward, you know what decisions you need to make. Now, you have a few weeks left this year to make changes if you need to. That's why it's imperative right now, imperative to know your numbers. You have to know exactly where you stand. So if you have an abundance of cash right now, and over the past few months, freight rates have been phenomenal, so I bet there are plenty of you out there that have an abundance of cash. And maybe you don't think of it as an abundance of cash, but let me tell you, if you have cash reserves right now that are more than you're used to, you have an abundance of cash, and you need to be aware of exactly where you stand so that you know what you can do to prepare yourself in the coming weeks. So there's some good ideas and bad ideas. I've seen a lot of people make some bad decisions based on their numbers, thinking that, rolling things into next year might be a good thing. We have to be careful with that. So I want to talk a little bit about that as well. I also see a lot of people running out and buying a lot of chrome and a lot of accessories, thinking that they can spend all of their money now and they won't have to pay tax on it, which is some give and take there. We have to understand exactly what we're getting into when we do that. There's also people that hold back their paperwork. This is something I've never understood. They hold back their paperwork so that they don't actually get paid for the work they've done this year, with the idea that they'll get paid next year. That could be a good thing, could be a bad thing. But the way the trends are right now, I'm leaning toward that's probably a bad thing. You probably need to submit those invoices, submit those bills, and try to get paid for that now, because next year, hopefully, will be better. Now, other things we need to take into account, of course, is the politics. The problem with taking politics into account, I've talked to people that said, well, the Trump tax plan is going through and we'll be taxed less next year, so let's not worry about it this year. Let's try to, roll everything over as much as we can next year, so that because next year's taxes will be lower, right? Problem there is we don't know what's going to happen. We don't know what the taxes will bring next year. We can only make decisions on what we do know right now. That's the best way to make a decision, is what's happening now, not gambling on what could happen later. Unless you have a surefire thing, okay? So we do know what the taxes are now. We do know what we can figure out, what we have or owe now. We can figure out what our cash on hand is, our profits, our losses now, and determine with some within a relatively accurate number exactly how much tax we're going to have to pay. And we can figure out, should we buy some things now? Should we hold back invoices? Should we submit everything we possibly can? Should we make sure that everybody, has paid up? If you have customers that are late on payments, you're not going to report that money until they actually pay you. So you have that option. And then there's also the situations where you may have late payments and they're not going to pay you at all. And that might be something that you would write those off as well. Now, my terminology, I don't want it to confuse people when I say write something off. When you write off a loss, again, there's different ways of accounting. Most of us are on a cash accounting system rather than an accrual accounting system. So you pay taxes on the money as you receive it. On an accrual basis, you would pay it as you earn it, even though you haven't been paid yet. So If a customer owed you something, you would pay tax on it because they owe it to you. If they don't pay you, you write that off. So write-off is oftentimes a term that gets thrown around that people don't understand. So again, we need to know where we stand first before we can do anything. You always have to know your cost. You have to know your cost of operation. You have to know your cost of profit, your loss, everything. You have to know all of those numbers to make any kind of educated decision right now. Now, I'm going to go ahead. We have a phone call already on, so let me jump to the phones so we don't lose anybody. We will go to the 623 area code. Caller, welcome to the show.
Hey, Kenny, it's Rusty. I was calling about the taxes, and I didn't know my numbers. $261 a mile gross and 60 cents a mile, all costs for everything. Insurance, fuel, tires, office supplies, parking, everything.
Okay.
60 cents a mile. My question is that I bought a 2002 trailer dry van a year and a half ago just to dabble in the dry van market. But in the last 60 days, I've turned 80% from flatbed to dry van, and the trailer I'm pulling, let's just say it's less than beautiful.
Right.
So I've got some cash. I'm having some issues sliding the tandem. So I'm just kind of looking at that. Do I dump $3,000 into a whole new set of air ride suspension because it's a spring ride to bring it up to date and still have a 2002 trailer, or do I go out and buy a new/newer trailer, 2010 and newer, something like that? I don't know. What are your thoughts there? I mean, we've got the capital to just pay cash for the trailer, a newer trailer, anything less than like $40,000, but I'm kind of looking at the signature trailer versus other stuff that's out there, or to build my own.
Okay.
What are your thoughts there?
Well, my thoughts are this. So you're looking at, you have a trailer now. What is that trailer worth? If you were to sell it on the market right now, what do you think you could get for it?
One of my customers offered to buy it for $4,000.
Okay.
I paid $45,000 for it.
Got it. If you take those axles out and you put $3,000 into fixing it up, what could you sell it for then?
Not much more, probably an extra $1,000, but the cost to put the new axles in is $3,000.
Right. So you might be able to get maybe $5,000 after you put $3,000 into it. So in my opinion, you're not going to see your return on investment versus if you sold it, and it's going to require a little bit of shopping, of course. What's out there? If you sold that, could you buy a trailer that's in much better condition? You said this one's not the prettiest thing to look at, so maybe you could find something that's in better condition, maybe a little newer. Sell the trailer you have for the $4,000 to $5,000 range, and put that other $3,000 that you have set aside for that, and now you've got your $7,000 to $8,000. Could you buy a better trailer for $7,000 to $8,000? My guess is you probably could, especially knowing you and the way that you like to find these great deals. So, I think, in my opinion, it would probably be better to take that money and put it into a better upgraded trailer from what you have.
Well, I guess what I'm looking at, though, is I'm looking at more of everything. I'm looking at is 15,000 plus, and I'm looking at a 2009 and newer because that's when the air pole came in.
Right.
Because I'm finding out that the trailer pins to slide those axles back and forth is such a large workman's comp claim that's the reason why almost everybody has the air poles. And so that's what I'm looking at is 2010 and newer, and everything is 15 plus thousand. So is it worth spending the extra, $12,000, or I guess it'd be $10,000 extra to buy a 2010 versus putting the $3,000 into what I have, or even spending even double that to buy a new one? I mean,
if your trailer right now was sitting on the lot for $7,000, would you buy it?
No, probably not.
Okay, I think that's your decision, because what you're doing is you've already put the $4,000 in it. You said it's worth about $4,000, so you've got that asset there, and you want to put another $3,000 in it, so that's $7,000. So basically, what you're saying is, because you already own it, it's easier. I get that, but essentially, it's the same thing. You're going to put another $3,000 into something that's not, you may not even be able to get your money back out of it. So In my opinion, it's not a good idea to do that. Now, there are a lot of people that would. So if you can find a better way to do it. Now, I bought a set of bogies once for $500. Air ride, everything was set up, and all you had to do is swap it out. If you can find a better setup, that might be something that you might be able to do. I don't think that I would put $3,000 into a trailer that's just barely worth more than that. So that's kind of where I stand on it right now.
Okay.
You know, and as far as for the tax purposes, it's never a good idea to spend money just to save taxes, but you already know that.
Right. Okay.
Right? So, yeah, it's not a good idea to spend money on something you wouldn't need. So, you know, don't let that be a factor in the decision here. Would you do this if the trailer was sitting there for $4,000 and you knew you had to put another $3,000 into it? Would you still buy the trailer? Probably not. If you could sell the trailer for $4,000 now, that might be the way to go. So that's probably the best bet. And then, you know, the reason that the trailers you're looking at are more is because you're looking at something that's much newer, because you're looking at options that weren't available prior to that. So, you know, could you find something older that doesn't have that air slide? That's a trade-off that you have to make a decision on your own. Those are kind of separate decisions, but it rolls into it. I don't think it would be the best financially wise decision to spend $3,000 on a trailer that, you know, you won't add any value to the trailer itself, other than you'll be able to continue using it, of course.
Okay. Yeah, it's just the ease of everything, but no, it makes sense what you're saying. Thank you.
Right. All right, Rusty. Thanks for the call, as always. Again, if you've got any other questions or comments, call 917-889-9924. Now, to hit on a point that I said there, it's not a good idea to spend money to save taxes, and I want to explain why. A lot of people, as I said, the term write-off confuses people. A lot of people don't understand what happens when you write something off. Even people that are pretty well versed in how taxes work sometimes don't think this all the way through when they say it. It's a tax write-off. You spend something, it's a tax write-off. I get that. What does it mean when you write something off? If it's for, obviously, you know, like in Rusty's case, he's going to spend money when he'll have something in return. He has something of value. He doesn't have to pay tax on that money anymore. If that thing that you're buying is something that you need anyway, then it makes sense to go ahead and buy it before the end of the year. You don't have to pay income tax on that money. So, for example, let's say December 31st, you decide, hey, I would like to go buy this trailer. And maybe depreciation and things roll into this, but I would like to buy this piece of equipment or this tool or tires or repairs or whatever it is that you say you need. You could either buy it on December 31st, and let's say those things cost you $1,000 or $10,000. So you could buy it on December 31st, or you could wait until the 1st of January and do the same thing. If you did it on the 1st, you would have to pay tax on that money. So typically most people are in around the 30% tax bracket. So you'd have to spend about $3,000. You have to give it to Uncle Sam. That's no longer your money. And then you'd have to spend the $10,000. Or you can spend the $10,000 on December 31st. You don't have to pay tax on it because you can write it off, and you don't have to give the government that $3,000. So essentially, whatever that purchase or repair is would save you that 30%. But that's all it saves you. What you have to be very clear on is that if you spend $1, that doesn't mean you get $1 back or that you get to keep $1. That just simply means you don't have to pay tax on it. And like I said, most people are in that roughly 30% tax bracket, which means for each dollar you spend, you don't have to pay an additional 30 cents tax. You get to keep that money. So you'll get the asset that you spent the money on, and you don't have to pay tax on it. Versus if you wait until after the year, you have to pay tax on the money, and you would purchase this item. But it's better to keep the cash in your pocket, pay the tax, than to buy items that you don't need. It doesn't make any sense to buy items that you don't want or need just to save money on tax. And I see a lot of people go out and do that. There are a lot of people that they would never, throughout the year buy any chrome or, do anything, fancy to their truck. And their mindset is, this is a tool. I only use it for work. I would never do that. But then they get close to the end of the year and they say, wait a minute, what can I buy? What can I spend my money on so I don't have to pay tax? And they run out and they buy a bunch of things they otherwise wouldn't. Be very, very careful not to do that. Looks like we have a lot of callers on. I don't have a call screener tonight, so I will call you in from your area code. But go ahead, and if you're on the line now, go ahead and press number 1, and I'll bring you on live. Or if you're watching the live streams, go ahead and call the number 917-889-9924, and go ahead and press 1 when you get in the room, and I'll bring you on. Looks like we do have another caller. We'll go to the caller from 773 area code. Caller, welcome to the show.
Hey, what's up, Ken? My name is Noah from over here in Chicago. I met your wife over there in Dallas once we were up to the show. I think you were there yourself. How you doing?
Great. How are you?
I'm doing fine. I'm a fleet owner. I mean, it's towards what your discussion is with taxes and all that stuff. I want to see like what's your input in something that I did a couple months ago. So I had a buddy of mine. He had a trailer paid out. It was a 2017. Had skirts on it and everything, new tires, new brakes and stuff. So it had all that good stuff. It was I know I was shopping around for these type of trailers, and they were around their 28, 26. And then I had the option to buy it cash. So I bought it cash for $20,000. So I had a good deal on it. Would have done the same, or would you got to take it out a loan? I didn't took out a loan for this, but would you have taken out a loan for it, or if you had the money sitting, would you have done what I did?
If you can pay cash for anything, it's always better to pay cash for something and not pay that interest. Is that what you're getting at? Should you have taken it and wrote and did a write-off with the interest? Is that where you're going with this?
Not really. Like, first, like the tax. I mean, of course, I'm gonna have to pay tax for all that stuff. But I mean, I have like, let's say, I could probably have like 2 more that I could buy out right now. But it's just like I don't know where. I don't like towards the conversation that you guys are having. It's about like, people have a little something extra, so they don't know what to do with it, so they just buy chrome stuff, like stuff you don't need that are just like, cosmetic stuff. But I mean, this is stuff it's you're replacing your dry vans and stuff like that. But I mean, what would you do in a situation where you would be like certain in my shoes? Like, what would you do?
Okay, if you have an opportunity to buy equipment and get a great deal on it, and you would buy it anyway, absolutely. If you can pay cash for it, pay cash for it. There's no reason to take a loan out on it if you have the opportunity to do that. Now, if you need to take a loan out on it, if the numbers work, if you can get a good deal on a loan, I wouldn't go out and buy, get a loan that's like a 30% APR or something like that. But if you can get a good deal on a loan because you need to, and you can still get a good deal on these trailers, it comes down to the numbers. But as far as paying cash, it's always a good idea to pay cash versus taking out a loan and paying interest on anything. So you save all of that money. You save the money that you pay in interest by paying cash. Now, here's the thing. You're buying trailers. So trailers are an asset that you depreciate over 5 years. And I get into this discussion a lot with people that say it's better to lease equipment than to buy equipment. And I completely disagree with that. If you can buy equipment, you have so much more flexibility in what you do with it with the tax write-offs. So you have the opportunity. Right now, I believe we can write off Section 179 up to $500,000. So you could spend $500,000 and not have to pay cash on it in 1 year. Okay? Or you can depreciate those trailers over 5 years. And you have the option of depreciating those down to zero, for one thing. So every penny you spend on those trailers, you can write off. And you can write it off equal payments over 5 years, right down to zero. Or you can say, wait a minute, those trailers will be worth, $5,000 or $10,000 in 5 years. You can depreciate it down to that much. It's called the salvage amount. You can depreciate it down to the salvage. And then in 5 years, if you sell those trailers, you don't have to pay cash on that amount. Or you can do a double declining balance, which means you could write off more up front and a little less each year, which makes sense because that trailer is worth a little bit less each year. Even though you paid cash for it, you can still depreciate it over time. Or you can, again, Section 179 and depreciate the whole thing right now. So there's a lot more flexibility with how you depreciate and take the deduction on those trailers. You still write off every single penny that you spend, and you don't have any interest to spend the money on. So especially something like interest, because as I said before, on December 31st, if you buy something in exchange and you get something of value back, at least you have that tangible thing back, right? But interest, you don't get anything back. That's a fee that you pay for the privilege of borrowing somebody else's money. So you have to spend that money. You don't have anything in return. If you can save on interest, absolutely pay cash if you have the ability. Just for some people, don't overextend yourself so where you spend all of your liquid assets, all of your cash, to the point that now you have to borrow money, possibly in high risk, just to stay afloat. It's better to have liquid money in the bank and borrow against your money, because you always get a better interest rate. This is getting a little deeper than I wanted to tonight, but you always get a better interest rate when you borrow against your own cash money than if you borrow against, a depreciating asset. So again, this is something, you might want to talk to an accountant about some of the different opportunities you have before you decide which way you want to go. And again, you want to spend, see where you stand right now. If you can still, a lot of people will buy equipment, and at the end of the year, they actually show a loss. They'll actually, most new startup companies in the first 2 to 3 years show a loss on the books because they write off more than they actually make, which can be good because, they're not paying any tax essentially. But it could be bad when you go to finance things. There's no way to show that you had any income, even though in your case, you spent all this money now, right? And so, but you're going to depreciate that over up to 5 years from now. 5 years from now, you're still writing off money that you spent 5 years ago. And there's no way to reflect that when you go to take out a loan. Let's say you're buying more equipment, or you're on the personal side, maybe buying a house, or maybe for the business, you're buying a yard or a terminal, something like that. So you have to be careful how you do it. But it does give you a lot more flexibility to just go ahead and buy versus taking out a loan. Now, and let me clarify that real quick. I didn't mean to say it quite like that. Even if you take out a loan, you can still write it off. So this year you would write off that entire amount, and you can kind of prorate it. So you're going to write it off over 4 years. But if you buy something in December, you're not going to take the deduction for the full year. You would prorate it for the year basically. And even if you were to take out a loan, essentially you bought that entire thing. It'd be like if you went to a store and you swiped a credit card, you paid for the entire amount now. But now you have to pay a third party for the privilege of buying it. You have to pay them over time and give them additional money, interest, for the privilege of using their money. So it's better to pay cash if you can. You either finance it or pay cash for it. You still get the same tax write-offs. Yes, you can write off interest, but again, interest is something with virtually no return. So it's better to not have to pay it than to pay it just for a tax return, tax write-off.
Gotcha. I appreciate the feedback on this, Kenny.
Awesome. So what you'll need to do now is look at your books, look at your profit and loss statement, and see where you stand. If it would benefit you to have some more tax write-offs this year, try to buy them before the end of the year. I will say, though, we need to look at the market and look at what's going on and look at the trends. It looks as though rates will be going into 2018 higher than we've gone into any year I can remember with rates, which seems to me 2018 we should make more money than we made in 2017. If that's the case, you may want to try to save those because you may prefer to have those write-offs start in 2018. Again, you could do the Section 179 and take that full write-off 2018. So, but if you bought it this year, you would not be able to take that full amount next year. That's the one, catch to the Section 179 deduction. It has to be taken in the tax year that you spent the money.
Yeah, that's really deep. I actually feel like that idea better, because towards what we've seen and towards what the ELDs coming, towards what I see in the market, rates are coming up further than we started at the beginning of this year. So that's why I'm still holding off to see the first week of the ELDs once they hit, I want to see how the market's going to be and all that stuff before I even buy anything else. That's why I'm like kind of holding off on buying any more equipment. But I mean, if it happens to be, I'll be ready for it.
Right. Well, and again, that's, forward thinking, and you're thinking about next year. But before you even consider that, you need to see where you stand this year. So look at your profit and loss statement now. Get your books current now, so that, because if you owe, if it shows that you're, a couple $100,000 ahead of where you thought you were, if you're running a fleet and you have to pay tax on that, it could be, very beneficial to have the option to write those trailers off, since you're going to pay for those anyway. Yeah, again, if you're in the 30% tax bracket, if you can write off an extra $40,000 and save, an extra, what would it be, about $12,000 in taxes, just because you can write that off as a 179 deduction, that could be awesome. That's huge. Versus if you wait until after the first of the year, then you find out that you have all these taxes owed. Now there's nothing you can do about it.
Right. Yeah. Yeah. I have to sit down with my accountant and see what the next step we're going to be taking. But I appreciate your input on this, Kenny.
Awesome. Well, I'm glad I could help, and I'll go ahead and put you back on hold here. All right, we have plenty of calls on the line. Again, if you have any questions, comments, 917-889-9924 is the number. Call now, press number 1 to raise your hand so I see you in the room here, and I will bring you on the air. And it looks like we do have a call screener now. So my call screener is in the house. So we are ready to go with call screening. If you have any questions, I won't just bring you on the air cold. You'll have a chance to put your name and information out there, so I have a little bit of time, and Elizabeth can help you get your questions straight. So Elizabeth is screening calls now. I just saw her pop into the room. Again, we're streaming live simultaneously on YouTube and on Facebook. Because we've got so much going on, I can't really look at all of the questions here. Let me scroll through quick. Okay, and I see somebody says they're questioning Rusty. He said, did he say his costs are only 60 cents per mile? I caught that too. I was going to call him out on that. I didn't, because this is Rusty, and Rusty is he is one of the penny pinchers in the group. One of the things that you have to be careful of when you look at cost per mile, I guarantee you that his cost per mile is more than 60 cents per mile, but the way that he looks at his numbers is that 60 cents per mile is his operational cost. He doesn't owe anything on his truck. So whatever his fuel, maintenance, and all of his bills come up to, that's what he includes in his cents per mile. This is one of the reasons people have to have a better understanding of what their cost per mile is. I give a presentation in a group. I did it at the Drive seminar, where I go around the room and ask people what their cost per mile is, or what their cost to move a load would be. And I get people that say things like that. They say, my cost per mile is 60 cents per mile, or my cost is so forth. Then my first question is, what do you pay your driver? Because if your cost is 60 cents per mile, which includes your fuel, your maintenance, all of your parking, your fees, your office expenses, everything, like Rusty said, that means your driver is not factored in. Now, even if you drive the truck yourself, you should at least consider what your pay is. You don't have to include it. You can break it out separately if you would like to. But when you're looking at loads and when you're booking freight, you need to consider what your driver gets paid, even if you are the driver. Now, something to think about. If you had a truck payment of $3,000 per month and you made that last payment, does that mean the following week your cost goes down and that you don't have to charge as much? Or that you wouldn't charge as much because your cost went down? You struggle for 5 years to pay this $3,000 a month, right? You struggle to pay that. And on the very last payment, does that mean that from then on you start hauling with the cheap freight, quote unquote? And I don't like that term, but I'm throwing that out there, cheap freight, just because your truck is paid off. Probably not. But a lot of people buy a truck, buy a used truck, pay cash for it, or have virtually zero payment. They don't ever factor in what the actual cost of the truck is, or the maintenance, or the replacement cost, or major malfunction cost. I'm going to do a YouTube video, and I am going to break down how to figure your cost per mile and how to use your cost per mile to quote a load. I'm also going to explain that using your cost per mile alone to quote a load is a bad way to quote a load. And, so stay tuned for that. I'll be talking about how to quote a load and figure your cost per mile, and to understand that if you are in competition with another company and your cost is 60 cents per mile in your mind, the only way that you can compete with this other company whose other cost might be 60 cents per mile also is if you dip into your driver pay. You have to be willing to take money off of your own pay in order to compete, which is okay as long as you understand that. As long as you understand that you can work for a penny a mile or 2, 3, 10 cents a mile, 20 cents, whatever it is, you can do it cheaper than the next guy. But that money is coming out of your pay, your driver pay. If you had a driver in your truck, now my whole theme to the Drive seminar, the whole theme was perspective. And I want people to look at all of these things from every different angle. Now, what we're looking at here of just your cost, not including your driver pay, just your cost is one thing. But also look at it, if you had a driver in that truck, would that change the decisions that you make? If you were just dispatching that truck, you're paying a driver, whatever the magic number is, 50 cents a mile. If you're paying a driver 50 cents a mile, by the time you add roughly 25 cents for workman's comp, plus payroll taxes and so forth, you're roughly around 63%, or 63 cents. So 63 cents per mile. His cost, he said, was 60 cents per mile. If his driver cost on top of that was 63 cents per mile, would that change anything? For most people, I think it would. I think it would change the way that they negotiate. It would change the way that they look at the lanes. And I think most people, when they start to think that way, put more money on the bottom line because they start to be more aggressive and make better financial choices not to dip into that driver pay. And the thought process there with that 60 cents per mile figure is whatever's left is mine. Anything above that cost is mine. Which is kind of true if you own the company, but you really should understand a little bit deeper than that. And I know Rusty does, which is really why I didn't rib him on this stuff, because I've had this talk with him before, and I understand he understands his numbers better than most people. But beyond the 60 cents per mile, there are other costs. So his cost is 60 cents per mile, but let's say that today he decides to take the day off, or this week he decides to go on a cruise. If the truck is still sitting there, costs are still building. Costs are still piling up. If you just let that truck sit there, unless you cancel the insurance, you take, and get rid of it, you don't have any taxes on it, you don't have, you can take the license plates off it, you never pay for any of that, you never pay insurance, then maybe you don't have any other costs. But you still have a cost if that truck is sitting there. So understand that you have a daily cost as well. There is time involved with your cost. It's not just per mile. Now, the reason that I like to explain that both ways is because when people start thinking about cost per mile and they only base their rates on a cost per mile, they start chasing miles. There's another YouTuber that I've had it out with, butted heads over this before. I completely understand why you need to know cost per mile. It's a super important number. But he was telling me that that's the only figure you need. A cost per day or time factor doesn't play into it. You just have to guesstimate that. And especially with ELDs coming up, the one thing that ELDs are going to do is put an emphasis on the time involved with these loads. And you have to have a formula to figure out what your time is worth. Because if you're sitting at a dock or you're waiting if you figure out a load and that load will take you 10 hours to pick up and deliver, you only have 1 hour left. Essentially, your day is done. You can't really do anything else. A lot of people don't think about it that way right now because they can make it work. They could still do what they have to do on paper to go take that extra hour and run pick up another load. That might not be a possibility on ELDs. You really have to figure out the exact time involved for each load, not just miles. And you have to figure if that load now is tying up the truck to where you can't load until the next day, that puts you on a whole day behind what others might think. So it's important to understand that your fixed costs being if you have a truck payment, you have insurance, you have license plates, you have that office that's there all the time, your parking fees, things that you pay all the time, those don't change. No matter if the truck is rolling or not, that doesn't change. So if the truck sits there in your driveway, there are costs that are still building up. Versus if you start driving, those costs get spread out over the miles. So it's good to know what your cost per day is and what your cost per mile is. And I like to separate it, your fixed cost daily and your operational cost, your variable cost per mile. That way, you can use a combination of those two figures to really justify what a load needs to pay. And I also like to work that driver pay number into that, knowing that if you don't get that number, that's coming out of your pocket. If you had a driver that you had to pay for, would you be able to afford it? Would this run still be profitable? You really need to know what those numbers are. We have a lot of callers on the phone lines. If anybody's on the phone listening, go ahead and press number 1 if you have any questions or comments. You got to press 1 on your keypad. That'll raise your hand, and we will get you on the air. Elizabeth is screening calls. I see her in the room now. I also have several people watching on Facebook and on YouTube. Looks like more people on the Facebook side. But I will be doing these videos on both platforms from now on. We'll give this a shot and see how it goes. All right, so before we get too deep into this, I want to keep going with end-of-year preparations. Knowing your costs, knowing your profit, your loss, knowing where you stand, to understand should you buy equipment now so that you have the write-off. Knowing should you wait until after the first of the year to buy that same equipment. That's an important number to understand. It's also good to make projections for next year. I think most people are going to have a higher gross revenue next year, and gross taxable income next year than they will this year. So I think it's probably wise. Now, this is a little bit of crystal ball stuff here. It's probably a good idea if you have any expenses. If you're on the line and you don't necessarily need those write-offs this year, it's probably a good idea to wait until next year when you're probably going to have more to write off against. Orlin asks, are there other taxes like highway use tax, KYU, other than IFTA I need to pay the state of PA or New Jersey if traveling through and or delivering in? All of those are quarterly, and it doesn't necessarily matter that it's at the end of the year, other than you may have to renew some of those accounts. You'll have to renew each of those. New York doesn't renew this year. They're on a 3-year cycle. IFTA, you will obviously have to renew that and get your new stickers. I've got my stickers coming this week. PA and New Jersey are also quarterly. Now, PA and New Jersey, what they're asking for, they require a tax be paid, and they have a set limit. If you do a certain dollar amount of business in those states. Now, New Jersey is right down to 0. If you do any business in New Jersey, you're supposed to fill a tax return out. Now, little bit of a loophole there is New Jersey and Pennsylvania don't recognize out-of-state LLCs. They also don't tax out-of-state sole proprietors. So LLCs don't necessarily have to do this. But if you're incorporated, you will have to file as a foreign corporation, essentially, for any business that you did in or around New Jersey, Pennsylvania. Now, New Jersey is they have been known to impound trucks that don't pay this tax. That being said, I've mentioned many times our attorney friend Hank Seaton, who is a big Washington, D.C. attorney. He lives up there near Washington in Virginia. And his advice is it's better to ask forgiveness than permission, because once you file, it becomes expensive and time consuming to continue filing. And most people go 30 years and they close down their business and they retire before they ever have an issue with this. It's not if you pass through. It's not if you do just intrastate work and you're picking up and delivering. It's if you pick up or deliver in those states. That's what's weird about those two particular states. If you do business in those states at all, you pick up a load there, the origin is in one of those states, or it delivers in one of those states. It doesn't have to be both, and it could be either or. They require this form to be filled out. But again, this is one of those where it's better, and you need to, it's an accountant issue, not a legal issue. That's where a lot of people get hung up, because there are issues with various states. Some states have DOT requirements. Some states have Department of Taxation requirements. So you have to check each state. Now, that being said, there are 3 states you should know about in particular. Those states are Florida, Arizona, and Tennessee. Florida, Arizona, and Tennessee. Those 3 states are super important, because those 3 states are the only states where you don't have any requirements. Every other state, you have to do something. The problem is, after deregulation and after the UCR and after all these different things pass, it's not supposed to be that way. We're supposed to be free to conduct interstate commerce without having to pay taxes and fill out tax returns and file for each state and all this stuff. We're not supposed to have to do that. But some states are money hungry, and they do everything they can to twist these and make it, as bad and hard as they possibly can. PA and New Jersey, I haven't heard any enforcement issues in a year or two now. Last I heard was there was a fleet out of Canada that was not registered there, had a whole fleet of trucks that they impounded every single truck that went into the state because of this particular tax. The problem was, because they were a Canadian company, to file in the U.S. was a much more difficult process. So there are some interesting loopholes to deal with this stuff. All right. Let me check the phones here. We have some calls. All right, we're going to go to Jason Pote, the trucker's coach in Kentucky. Jason, welcome to the show.
Hey, Kenny, how you doing, man?
Awesome. How's it going? What can we do for you?
Hey, got a question for you. Hey, as you know, I just got my own authority and running Jarhead Transportation. And what time of the year would you think would be the best time of the year to buy equipment? And is it to buy it at the end of the year for the tax write-off at the end, or is it better to write it off in the beginning of the tax year? If you plan to buy equipment during the year, would be my question.
You have the option, no matter when you buy it, you have the option to write it off the same way. If you buy it later in the year, there is a way to basically prorate that write-off. Now, if you're buying big equipment, or what are you talking about? Buying trailers, trucks? What are you looking at buying?
Trucks, trailers, yeah.
Okay, so they're not really trucks. IRS classifies them as highway tractors. Highway tractors, you write those off over 3 years, and trailers, you write off over 5 years. Now, you have the option to Section 179, any of this stuff, up to $500,000 a year. And if you bought something on December 31st, you have that option. Or you have the option to depreciate it over those times. So again, if you buy a tractor, a highway tractor, you depreciate that over 3 years. You can take, let's say it's a $30,000 tractor, you could do $10,000 a year for 3 years. Or you could do double, what's the term? Double depreciation, where you could take $15,000 the first year, you could take $7,500 the next year, or whatever the equation is, and then finish out the final year. Benefit to that is you spend all your money the first year, you can deduct the majority of that up front, and then you can take a little less next year and a little less to final it out the next year. So you have the option at any time during the year, January 1st to December 31st, you can deduct that piece of equipment. Doesn't matter when you buy it. Right now, it's important to look at what your numbers are because you need to understand if you're going to buy that piece of equipment, if you've got the money or you've got the financing, whatever it is, if you are going to owe a whole lot of tax because you made a whole lot of money this year, it's better to buy it now and take the write-off so you don't have to pay tax on the money on equipment that you're going to buy anyway. But if you're going to, I know you just started this company. Essentially, you just started a new business. I'm sure you had a lot of startup expenses. I know you just bought a trailer this year. So you already have a lot of write-offs. You may not need the write-offs this year. Yeah. You might already be, in the red, this year for the startup cost and everything else. So look at your numbers and determine if you bought it this year, if you're already in the red. Let's say that you made, after all your expenses and everything, let's say that your taxable money is roughly $30,000. Then you go out and you buy a $50,000 piece of equipment. Then you take the Section 179 deduction and you write off all $50,000 against the $30,000 that you're paying tax on. The problem is that other $20,000 you lose.
$20 in a hole. Yeah.
You don't, and you can't gain that back. You can't deduct it all and then take the rest next year. It's all or nothing.
You can't. Yeah. You can't carry it over, right?
Right, but you could spread that out and do a depreciation schedule, but it's better to know now. The thing is, let's say you using that same figure. Let's say you had $30,000 this year that you're going to pay tax on. You just started this new business. Chances are next year, especially the way rates are going, next year you will have less startup expenses. You won't have any startup expenses. You have just normal operating costs. And then rates are going up, and they'll probably continue to stay high through next year. That seems to be what all the predictions are. You'll probably make more money next year than you will this year. It's probably better to wait until after the first of the year to buy equipment right now. But it really depends. How much tax do you owe right now? You'll only know that if you get your numbers squared away now.
No. Yeah, it's mainly a 2018 question. I was just wondering if we were going to do it, if it's better to do it. I'd always heard that some people say it's like specific times of the year, so I wanted to see if I could get clarification if I could still get the same, whether I'm going to depreciate over 3 years, 5 years on a trailer, or take the 179. I can still do it in the same calendar year, no matter when I bought the equipment. So I wanted to make sure that I could do that because you hear different things and stuff like that. So I just wanted to clarify, if there was specific time in order, like if, say for instance, if I bought it before July or June, the first 6 months of the year I could do this, and if I bought it after June or something like that. So as long as there's no time deadline or whatnot, then that was the main issue I was having. I wanted to make sure that I wasn't on a deadline.
No, there is a way, and I would have to look it back up. There is a way, again, to prorate it. So if you bought this equipment in the fourth quarter, you wouldn't necessarily have to write off or wouldn't be able to write off the whole thing for that year. Anytime you buy equipment within a calendar year, you have the option for the 179 deduction and everything. But the way the depreciation schedule works out, you could basically prorate your write-off for that part of the year. There is a formula for that. Again, I'd have to look that up to tell you exactly what that is. But I believe it has to be less than 4 months toward the end of the year. You'd have to double check on that. But then you can prorate the amount that you...
So that would put you... so that would put you, around August then if you wanted to get into the prorated part?
Right. But again, most people that buy equipment don't necessarily want to prorate it because it doesn't necessarily benefit them. They spent all the money now. Why would you want to take the deduction later? Let's take the deduction when you spend the money, because if you don't take the deduction now, you have to pay tax on that money. So let's say you spend, that's kind of where it gets a little bit tricky. And, as far as spending cash on things and not, if you spend $50,000 on a piece of equipment, Section 179 says you can take that whole write-off right now. But it's $50,000, and for simple math, we're going to say we do just simple depreciation, $10,000 over 5 years for a trailer. Well, you would write off $10,000 this year. You spent $50,000 you can only write off 10 now, which means you have to pay tax on that other 40
Gotcha.
still. That's where the depreciation gets a little tricky, because you still have to spend, still have to pay tax on that. Now, eventually you write off all 50,000, but it's a little at a time. Okay, so if you,
Sure.
let's say you
it's
had,
over that 3-year period.
let's say you had exactly $50,000 in the bank on December 31st, and you buy a $50,000 trailer, and then you decide to depreciate it. On January 1st, you depreciate 10,000 of that. You owe tax on the other 40. Where do you come up with another roughly $12,000 just in tax? Right? But you could do the Section 179. You wouldn't owe that. You would not owe that $12,000, but you wouldn't have a write-off next year.
Gotcha. Yeah.
Okay, so it really gets. It
Okay.
comes down to the numbers every time. You have to figure, and it's a good idea. When you get into where it's that close, it's a good idea to sit down with an accountant and see where you stand. Sitting down with an accountant before the end of the year is a good idea, and figure out where you stand. Right. I know right now a lot of accountants are just swamped because people are making those last-minute decisions trying to get their books ready. The other thing is, come January 1st. You can file your tax return for 2017. You can be done with it. You don't have to wait until March or April to file your tax returns. You can file it January 1st. You don't have to wait for 1099s to come in. 1099s don't get sent in with your tax returns anyway, as long as you have good bookkeeping. And you can send all that in as soon as the calendar flips over.
Gotcha. Well, no, I don't guess I got any more questions as far as the taxes go and stuff like that. It's been a good show. Been listening to the whole thing. I appreciate it. It's different being on this side of the phone, but hey, I like it.
Awesome. Well, I appreciate it. Why don't you go ahead? You gave me the opportunity. I'll do the same for you. Why don't you plug your show?
Hey, it's the Truckers Coach Show. It's on Blog Talk Radio just like this, and it's The Truckers Coach on YouTube. You guys go hit the subscribe button, and everything will be, I guess, about 9:30 Central tonight. We're going to have a short show this evening, but come on in and talk to us, and on Facebook, The Truckers Coach on Facebook groups too. And I appreciate it, Kenny. Thank you guys very much for having us on the show.
Awesome, Jason, and we'll listen in to you later. Have a good night. All right, so he plugged his, and I see there's other people that are asking the same question. We have a Facebook group, the Trucking with Authority Facebook group. That's where most of you tend to stream and listen live. I see there's a lot more people on Facebook streaming than there are on YouTube, but we are also streaming live on YouTube simultaneously at the same time. And the YouTube side is the Trucking with Authority YouTube channel. Now, YouTube is kind of cool because if you download the YouTube app and you go to the Trucking with Authority show, you find it on the app, you can subscribe to it, and there's a little bell. If you hit that bell, every time we go live, you will have an alert. That's been one of the biggest complaints that I've had. I send out events and invitations and things on Facebook, but it's hard to get that alert. If you subscribe to the channel on YouTube, you will get those alerts. So that's a good way to be alerted to when we go live. All right, so we're getting close to the top of the hour. Again, talk about taxes. We talk about the numbers. That's super important to understand before the end of the year. Getting it all together, and deciding what to do next. Now, a lot of people right now, and I spent the first hour talking about numbers. There's more to do at the end of the year than just numbers. Now is also a good time to review your business plan. Review what you've done this year, what has worked, what hasn't worked, so that come January 1st, you can start off fresh. For a lot of you, it's time to incorporate. Time to file that LLC, become an S-Corp, whatever the case may be. Again, that kind of comes back to the numbers, but if the numbers say to do it, then you have to come up with the plan to do it. It's a good time to review your business plan, or if you don't have a business plan, to write your business plan and get all the information you need together, do all of the research so that January 1st, you can pull the trigger and make things happen. It's a lot easier to start a new business or to change your business structure, or to, start a whole new accounting system, or new software programs, or new whatever it is, it's always a lot easier because it corresponds with the fiscal year, the tax year. It's always easier to do that on January 1st or January 2nd, as it were this year. I guess Tuesday, January 2nd. That's the best time to file and incorporate. If you do it prior to January 2nd, if you do it before the end of the year, remember that you'll still have to file a tax return for 2015 for that new company. When you start a corporation or an S Corp, LLC, whatever it is, you have started a brand new entity. If you start it before the end of the year, you will have to file a tax return for it. For a simple tax return for one of those type of companies with no information included, so if you start a brand new company now, it hasn't earned anything, you're just getting all the bookwork started and everything, you probably won't have any income or anything to report. It'll probably cost you in the neighborhood of $300 to $500 for that tax return, in addition to all the normal tax returns that you'd have to file anyway. So I advise you, unless there's some other reason that you would need to, I advise you, don't start a new entity, a new company now. It's a good idea to wait until the end of the year. Now, that being said, most states have a provision that you could fill out the applications now, and you can get the start date to be on the first of the year. So you can start that business. You can fill out the application, pay all the fees and so forth to get everything up and running, and it will start on the first. But do not start one prior to the first. Otherwise, that entity is in existence. And usually, we're still within a time frame that you would have time to do that. Usually, it takes a week or two for everything to be up and running. I think you would, if you filed now, it would actually be active before the end of the year, and you would be, you might get away without filing, but you're supposed to file your return for that entity before the end of the year. So it's best to go ahead and wait until the end of the year to file. And Rusty chimed in. He knew what I was talking about with the fixed costs and variable costs. His fixed costs per day are $80. So Rusty wasn't going down with a fight on that one. His fixed costs are $80. In addition to his 60 cents a mile cost. Now, I believe his $80 a day is if his truck just sits in his driveway, and then he figures if he's running it, he needs to make at least 60 cents a mile to break even. All right, we'll go ahead and scroll through some of these last Facebook comments here. We actually have several callers on the phone lines. If you're listening in, if you have anything you'd like to add, go ahead and press 1. I recognize a couple of these numbers in here. Go ahead and press 1 on your keypad at any time. I will bring you on the air. We still have a few minutes to go here. Phone lines will continue to stay open until we end the show tonight. I'm going to go ahead and scroll through some of these comments here on the social media networks here. And this will be the first. People are saying they prefer the YouTube stream. The only bad thing about the YouTube stream, and the reason I haven't done it in the past, and you guys can give me the feedback on this, I can see comments, but when the comments are starting, once I end the video, the comments go away. Unlike Facebook, as you guys are commenting on the video on Facebook, those comments stay attached to the video. And then we can start a discussion after the fact, and we can continue this discussion going on. And, a lot of questions get answered after the video is over. Versus on YouTube, these questions and comments and things over here just vanish afterwards. So you all let me know what you think about that. All right. There's a couple good questions here. All right. Real quick, let me read through these. And I don't usually like to read these on the while I'm live, but just because I'm streaming on 2 systems here, I'm going to go ahead and do so. Let's see. if anybody is willing to, if you've got too much money and you're afraid you just need the write-off, you can go ahead and send it to E Street here. So if you have too much money, I'll tell you what, send it to me and I'll make sure the right people get it. Go ahead and send me any extra money you have, and you can take the tax write-off. I will send you a receipt and everything. You can make sure you get that tax write-off. And I'll make sure that if you want it to go to certain people, that they will get it. I promise. Okay. So there's a couple comments about the depreciation hurting business credit. And you can't overcharge just because of an outrageous truck payment. One has no bearing on the other. And we'll talk about that real quick too. The driver figures they make more money driving, so they scratch the detention time to run the miles. That's the paper log issue that's going away with ELDs. Seems to me they don't know how to figure the detention time. I think they know how to figure the detention time. They just don't have the pressure to put on the shippers and receivers to get it paid all the time. Talk about that real quick too. All right. And what is a good tax program to keep up with your numbers? A single truck owner, a fleet owner, at least to a carrier. I've got that too. All right. So when it comes to rates, you need to know that you need to have a $ next to your clock. You need to know what your time is worth. I have a formula where I break it down. And if you've worked for several years in a row, the best number to use is the average of previous years. How many days of work are you doing? And I'm not talking about being away from home. I'm talking about the days that you're generating revenue with the truck. If you're out there away from home and it's and you're doing a 34, it's not what I'm talking about, because you're not charging your customer for that part. The time that you're actually charging for. If you're not under a load, what are you charging for? Now, some people do a load under that while they're doing their 34, and they work that in as well, and that's great as part of your negotiation because it ties up the truck for that long. But you need to understand how to figure that number out. Again, figure out how many days you're actually generating revenue with your equipment. If you don't have that, for people that are just starting out, I like to use 11 months at 4 weeks a month. It's 44 weeks. Do the math. There's 52 weeks in a year. Okay? So that's 8 weeks, which is essentially 2 months off. 4 weeks, 11 months. 5 days a week. That's 220 days. Use the figure of 220 days. Now, a lot of people say, 8 weeks off, that's too much. Well, remember, you're not counting days. You're doing the 34-hour restart. You're, pretty quickly adds up if you have a 3-day weekend. If you come home on a Thursday or you don't leave out until a Tuesday or so forth, those add up. You have 5 of those. That's a week. So most people take a week or two off during the summertime. Most people take a week or two off during the holidays. And, there's always going to be a few days here and there, or a week there, here or there that the truck is in the shop, or for whatever reason, you're not generating money. Again, this is a round figure, 220 days. I'm not talking about miles at all here. If you have actual numbers to go back on, if you can figure out how many days on average you're actually generating revenue with your equipment, use those numbers. For a lot of people, they're trying to run shorter miles, but they're still using that cost per mile number. Well, again, if your truck sits in the driveway and you did 0 miles, goose eggs, right? You have a cost associated with that. I have found that for most people, it's between $200 to $350 daily, depending on what your truck payment is and so forth. So if you have a payment of a daily cost of $250 just sitting still, now if you run 500 miles, that $250 daily cost gets spread out. That's 50 cents a mile. That's just your fixed cost, mind you. You still have to pay for fuel. You still have maintenance and all that stuff. If it's sitting in the driveway, those things don't rack up. They do when you're driving. So you have your operational cost on top of that. Rusty said his was 60 cents a mile. So we'll use that number. That's a pretty good number. On top of the 60 cents a mile, I like to add driver pay. Driver pay can go on either side. You could pay yourself a salary, maybe $1,000 a week salary or 50 cents a mile or whatever number that you work out. Figure that out. Again, you can figure out all your fixed costs over the full year, divide that by 220 days. Usually comes up, most people, again, it comes up typically around $150 a day. But in addition to that, think about your driver pay, profit, those types of things that should be added in if you're quoting the load, okay? Now, that being said, if you drive 0 or you drive 1 mile down the road, your cost, if it's 60 cents a mile plus $250 for each day that you're sitting there, you need $250.60 per mile to be profitable, okay? And that doesn't even include additional driver pay and so forth. If you drove 500 miles, you'd need that $300 of pay plus the $250. So you need $550 for the 500 miles just to break even. Okay, so understand that $550 over 500 miles is, what is that, about $1 a mile, something like that. So you're just barely over $1 per mile versus you go 1 mile, it's $250 a mile. That's your cost because of the time factor involved. All right. Now, E Street says you can't, I think it was E Street that made that comment, you can't just charge your customer any old rate because of your cost. That's true. But you have to adjust for the market. Now, if your cost is more than the market will bear, you will go out of business. That's why calculating your cost per mile, all costs per mile, is important. Okay, all your fixed costs, all your variable costs, everything. Calculate all of that per mile to know whether or not you're profitable. Know what that is. But when you're booking a load on a day-to-day basis or planning out your week, factor in the time to know what your time is worth for each of those days as well. But your cost per mile is imperative. Now, you can't just charge any old number. If you're coming into Florida, you might get a great rate, but coming out of Florida, if you figured your cost per mile is, it's 500 miles, you got to charge whatever your number ends up being. If they can't get that number, what do? You can't just charge it because your costs are higher. Well, that's true, but you have to make sure your average on those lanes, on everything you do, will compensate. So I always use Florida as an example because it's the most volatile market in the country. Coming into Florida, you're going to have to make your money to make sure that your average, even coming out, whether you take cheap freight on the way out or you just deadhead out, that average has to cover all of your expenses for your time and for your miles, both. Okay? So you can't just charge any old number because customers just won't pay whatever you want to pay. You have to adjust for the market. I've also figured out a pretty basic formula for that. Brokers, and I'll try to sum this up quick. I don't want to go too far into overtime. Brokers and shippers and things that do these long-term contracts, maybe a year long. Let's say that, using Florida market as an example again, let's say that most of the time your load-to-truck ratio is 4-to-1. There are four trucks to every load in Florida most of the time. That means if there are 4 trucks, 1 load, okay? 3 trucks don't get a load. Doesn't matter what you are willing to pay them. If they're willing to work for free, there is not enough freight to go around. 3 trucks have to leave empty, okay? That means the contract for those 4 trucks going in has to pay enough to pay the deadhead miles for at least 3 going out. Roughly 75% of the trucks are leaving empty. That contract's going to have to pay roughly 75% more going in. The 1 truck that gets a load out is lucky. The others have to try to get enough to deadhead out on the way in. Typically, that's how it works on those rates in and out. And I've seen this several times, and that's usually in the ballpark of how it is. Now, on the flip side, that 1 truck leaving, probably will only get about 25% or thereabouts of what they need to come back out. That being said, there's typically a line that most people won't work for. When it's too far below cost, most people won't take it anyway. So usually that 25% is usually a little bit higher because most people wouldn't take it. If Rusty's cost is 60 cents per mile, would he work for 25% of that? Probably not. Okay. So there's usually a line that's drawn. Most people it's not worth their time. And at that point, it's so severe, people understand the time involved. All right. So you have to charge enough going in. The way we used to say it is take your backhaul with you. If you're going into a market like Florida, you're going into the Northeast, you're going someplace where you're probably going to have to deadhead a good ways back out, figure out where the next best market is, calculate your rate good enough to take your backhaul with you. And remember, all miles are paid. Empty or loaded, all miles are paid, because at the end of the year, you're going to calculate your cost per mile, and your empty miles don't get separated. Your costs are the same on all miles. Yes, fuel prices fluctuate if you're pulling 45,000 pounds versus driving empty. You're going to average all that out because at the end of the year, you're going to know your cost per mile for every mile you drove. Okay? So you need to understand where your numbers are. All right. The next question. What is a good tax program to keep up with your numbers? Single truck owner, a fleet owner, or a lease to a carrier? All right. Across the board, the best answer for this, across the board, every tax accountant understands it. It's probably the most versatile, good for every kind of a business, is QuickBooks. QuickBooks will work for every operation. If you're self-employed, if you're leased to a carrier, you have your own authority, whatever it is, QuickBooks for tracking the numbers is the best software to use. It is not the best software to calculate your cost per mile with, although if you're good with Excel spreadsheets, you can print out your profit and loss from QuickBooks, and you can print it out in an XLS, an Excel spreadsheet format. And in Excel, it's real easy to put your miles and calculate a column of exactly what your cost per mile is. That's the best way to do it. There is a lot of software out there that will give you a running average of your cost per mile. Again, I don't like that kind of software. The reason I don't like that is because I think it's important to look at your cost per mile occasionally. I think it's important to look at your cost per mile maybe monthly. It's important to keep your cost per mile updated. The more you update it, so if you update it after every single trip, that's the most accurate way. Or if you update it every week when you get your settlement, or every month you sit down to do your books, the more often you update it and the more accurate you are with it, the better it is for your records and the better indicator it will be for you. I don't like people to look at it very often because, again, when you look at your cost per mile and you start basing everything you do on a per mile basis, you immediately get in the mindset of chasing miles. Again, I said I butt heads with this guy on Facebook quite a bit, or on YouTube rather, and he's all about cost per mile, and I completely agree with everything he says about cost per mile. All right, I don't discount anything about the way he calculates his cost per mile or what he uses his cost per mile for, except for bidding a load and knowing the time factor involved. Okay, if you look at this, and this gentleman, it's funny because he runs a fleet. And, they're hiring drivers now, and you just, not get into that. I think he'd be a great guy to work for. I know the people that work for him are great. They're happy with him. But he advertised his driving positions that you get 3,200 miles per week. That was a selling point for him because he's in the mindset of chasing miles. He even says in his videos, while you're out there making miles, when he's talking to drivers, you're out there making miles. It's the wrong mindset. In my opinion, it's the wrong mindset. We shouldn't be focused on making miles or earning a rate per mile. We should be focused on, honestly, who wouldn't just sit on your couch and eat Doritos all day and collect a paycheck, right? That would be the best job. And there's a lot of opportunity out here to solve problems for your customers, run less miles. Some of my trucks run, 2/3 of the miles that he's talking about, and I'm pretty sure that my trucks are more profitable than his, okay? because we're not focused on miles. We're focused on a good combination of miles and time. It's important to understand the correlation and the relationship there. So, yes, I think YouTube needs to fix, they need to keep the comments. I really, that's the reason I haven't used YouTube for these live streams, is because YouTube does away with the comments. So I could interact with you during the video, and I can read the questions and comments, but once the video's over, they're gone, and I hate that. I really like the way Facebook does it, and these stay up. And Jason says that, that's a great mindset for him, not his operators. I agree. And he sits behind a desk. And, I think what he does is similar to what I do as far as, running the fleet and being on this side of the steering wheel. Okay. But, and it's important when you're running a business to know your costs and know exactly, cost per mile and all this stuff. I don't focus on cost per mile so much. And maybe the reason that my mindset is a little different is because I work with owner operators. I need to know what my costs are for them, but not necessarily per mile. Okay, because it's important for them to know their costs individually, their cost per mile. I've had potential owner operators come in here and they want me to open up my books and say, what is your average rate per mile and all this kind of stuff. And I have to explain to them, to me, it's not important to track that. Okay, I have software available to track that, and I have shown reports from that. But working with owner operators is not a priority for me. But even when I was running my own truck, I would track my cost per mile as it pertained to the end of the year. Again, I don't want to get too far off track here, but QuickBooks is the best way to do it. If you have your own authority, you have to have some type of software that will do invoicing. QuickBooks does invoicing. Profit Gauges is another good program. Okay. I like Profit Gauges. As most of you know, I was under Kevin Rutherford's network. I did this show under the Audio Road for a long time, and I talked about Profit Gauges a lot. But, I kept going back to Aaron and saying, Aaron, this software has to print invoices. Here I'm doing a show and telling people that they got to go out and get their own authority. And the software that was part of that network did not print invoices. I know they're working on it. They were promising, even when I was with them, they should have had it earlier this year. I know that's a priority for them. Keep an eye on that. I think it's good software. It does give you that cost per mile on a running basis. So be careful with that. Keep this the time factor in mind. I mentioned that to them as well. I don't think that was something they were interested in. It's difficult to do time because you can look at your odometer and say, I ran this many miles. But you can't say, most people look at their logs and say, I was away from home for 30 days. Yeah, but you weren't generating revenue for each of those 30 days. So that, that does make it difficult. You can only calculate this on revenue generating days. Does make it a little more difficult, but it's a good idea to understand it. So Profit Gauges is good if you are leased to a carrier, because it will give you everything you need, and they have made it very simple. Okay. Once you have a truck and you get your own authority, again, getting some type of software that will either sync with QuickBooks, or with one truck, you really could do everything with QuickBooks. You don't need any trucking specific. Fogline software, though, is a good one. It's not all that expensive. It's one of those that it's not cloud-based, so you can buy it once at less than $200. You buy it one time. It will track everything you need. It will do invoicing. I don't believe it syncs to QuickBooks, though. So it's pretty standalone. Because it's trucking specific, sometimes it's a little difficult for those type of programs. If you have a somewhat unique operation, or if you're a problem solver. For me, I do some warehousing. I also do the broker stuff. I do different things, and sometimes there's unique situations that come up that trucking specific software doesn't always handle, but QuickBooks will. That's why my go-to is QuickBooks. But if you're doing a one truck operation and you're very focused on just that one truck motor carrier, and 2 or 3 trucks possibly, that Fogline software is great. It's very simple to use, very simple programming. It doesn't have a lot of bells and whistles. It's pretty easy, but it's not expensive and it'll last a long time. And good cloud-based. There's a few solutions for that. Trucking Office is another one. Trucking Office, and these are some of they're dipping their toes into being a TMS. They're trying to be a TMS, transportation management system, but they're so focused on the small carrier that they're not real good once you start getting a fleet, and they become a little bit cumbersome because there's a lot of workarounds you have to do to make some things happen. But Trucking Office is good. ITS, if you use truckstop.com, is good. One that is pretty great, and I'm actually switching over to myself, is Ascend, the free TMS, the freetms.com. I was working with them on trying to work a deal with them and DAT. DAT is one of my sponsors. I was working with Ascend to get something together for the Drive seminar I put on in October. We couldn't get things together, but Ascend is pretty good. They're great. I mean, phenomenal on the broker side of my business. They're amazing for cloud-based, and they're not that expensive. On the carrier side, they're pretty good. If you're running your own business and you don't have to do payroll and things, they're great. Now, they're working on that. Over the next couple of months, I think their payroll system is going to be top-notch, and I think Ascend is going to be the program to watch out for. You put all of your information in. It keeps track of all your loads, keeps track of your miles, has a lot of integration with maps and tracking and things like that. If you're going to grow a fleet, this is the way to go. If you're brokering, if you're doing a lot of loads on the outside carriers, Ascend is the way to go. Driver pay, it'll give you a report of all of the loads that have happened. And it's Ascend, ACSEND. And I think it's thefreetms.com. It is a transportation management system. It will not do all of your office, I bought a box of Staples, I'm going to put that in. Everything has to be load specific. It tracks loads, tracks your trucks, keeps driver files, all that type of thing. It's good for that. It's not that expensive. It's $45 a month per user, which is expensive for a one truck operation, but once you start growing, it's not expensive for what it is. It's per user, not per truck. Let me think. The other, if you're a member of NASTC, which I think everybody should be a member of NASTC, they have their own in-house software called Mystic. NASTC stands for National Association of Small Trucking Companies, NASTC. Their software is Mystic, MYSTC, managing your small trucking company. And it's pretty good too, but it's a TMS also. And it tracks all of your load information, pickup, delivery spots, gives you your miles, gives you your truck information. You can build your driver profiles, and it does a fantastic job. And I am using it currently for my driver pay sheets, for driver settlements for owner-operators. It does a fantastic job of that. I love it for that. It's the only software I've found that does this good of a job for this particular purpose. Syncs with your fuel cards, ports all that information over. It's easy to just select the loads you want to pay out. I like it, and again, it's a TMS. All of these programs that are transportation management systems, be it Ascend, Trucking Office, I believe is the same way, or Mystic, they are focused and they're very good about tracking the loads and the information, customer information. But if you go buy a box of Staples, there's no way to input that unless you can associate that with a load somehow. To overcome that, almost all of these companies will sync with QuickBooks. So brings you right back to QuickBooks. Small companies, QuickBooks is really all you need. If you get into where you're tracking a lot of driver information and load information, getting a transportation management system is probably a good idea on top of your QuickBooks. QuickBooks is probably the best way to go on its own. And again, Profit Gauges, if you're leased to a carrier, is a great program. And it does have the features to track all of your other office, everything else you buy. If you buy a box of Staples, all of your expenses. But unique situations that come up that are not trucking specific could be a little bit outside of the guidelines that they used when they built that software. QuickBooks, you can build a category for anything you need. So QuickBooks is very, very, I was going to say user-friendly, and that might not be a very good way to put it. It's difficult to set up. Once you get all of your categories set up and you get your accounting set up, it's easy to use. Getting it set up for the first time can be a little cumbersome. Once you get it set up, it's pretty easy to use everything. And then all of these other software on top of it will sync with it. And there are a lot of other apps and things that will sync with it. And I can also say that QuickBooks Online is a fantastic cloud-based program. You can get an app, and if you go buy something, you go to the truck stop and you have to buy a gallon of oil, you take a picture of the receipt right there, and it's pretty easy to sync that up with your books and everything, and you can all put it all right from your phone, and it makes life super simple. So QuickBooks is phenomenal for that. All right. P&L, profit and loss. So Jason, I guess he's asking, what is a P&L, or do these programs print out a P&L? P&L is your profit and loss sheet. It's going to be, and I am going to do a video on this, and I will show what a profit and loss sheet looks like. I will show you the different categories, different columns. I will show you how to use it to calculate your cost per mile. And profit and loss is how much money you spend and how much money you made, how much profit did you generate, and how much loss. And literally, it's profit and loss. Did you make money or not? Did you make money or did you lose money? Profit and loss sheet. That's what this sheet says. At the end of the year, that one sheet is all you would really need to give to your accountant. You print out one profit and loss sheet, you give that to your accountant, and they can do your taxes. That's the only paper they need. They don't need 1099s. They don't need your receipts. They don't need any of your books. They don't need to be able to access QuickBooks. They don't need to be able to access anything. You print out one page, your profit and loss statement, you give it to your accountant, and as long as you have everything categorized properly, that's all they need to do your taxes. And all of these programs will do that. Well, programs such as Profit Gauges will do that. Trucking Office will do that. The Fogline software will do that. As long as all of the categories that are pre-existing fit your business. Okay, so they will do that. All of these other TMS systems will not generate a profit and loss sheet. They will generate load-specific information, but you have to sync them to QuickBooks to generate a profit and loss sheet. Which software? Jason is saying, which software does that? So Mystic, Ascend, let me think. Mystic, Ascend, most of your TMS-based systems, transportation management systems. A TMS is built and designed to track load-specific and carriers, trucks, trailers, drivers. You build a driver profile, you build a trailer profile, a truck profile. If you work with outside carriers, you put their file together there, and it's all online or in your system. Everything that you need to keep track of all of that information is in this system. And then you build a load. Let's say the load's going from point A to point B. You put in the addresses. It will keep track of those. It'll calculate the miles between the two. It'll calculate who the customer or the broker is, and it'll sort out who the billing goes to. You can assign that. That's how you would print your rate confirmations. Anytime you've gotten a rate confirmation, it's coming from some type of software like that, a transportation management system. It's your rate confirmations, your driver sheets, your dispatch sheets, those types of things. Even if you're leased to a carrier that gives you their in-house version, it's going to give you just their load confirmations or so forth. They might not call it a rate confirmation. Whatever it is, these transportation management systems will do that. So you build the load, you assign, you pick the customer, you put in your pickup and delivery information, you assign the truck, the trailer, the driver to that load, and then this keeps track of all that. You put the billing information in, you put how much revenue you're billing the customer and how much you're paying the truck, and it will keep track of all that. Then it will sync to QuickBooks. QuickBooks will calculate all of that, so you have your income, your net revenue from trucking, you have your gross income from trucking, you have the payments out to your contractor payments, your fuel payments, and all that. It will track all that, and it will put it into QuickBooks in those categories. At the end of the year, you hit the profit and loss report, and it will print out one page of everything you've done for the year, and it will tell you all you need to know to give to your accountant and do your taxes. All right. let me scroll through, and we are like way into overtime here. Let's see what else we've got, and then I will cut this off. And then E Street says, trucking exec. Yep, and that's the guy I was talking about. You and him both have a wealth of knowledge. And I agree. The guy is brilliant. I've never tried to say he doesn't know what he's talking about. He's great. And I completely agree with what he says about cost per mile. Completely agree with it. But I just like to have that other bit of information about how to put a value on your time. And I think that's important when you're quoting loads. That's the only thing I disagree with him on. And I don't think I necessarily disagree. He agrees that time has value, but he doesn't have a formula to put a number on it. And, you know, he thinks my formula is not the greatest. But I think, again, I will do a video and maybe he'll comment on it. We'll find out. The difference is he's dealing with company drivers that want a company that get 3,200 miles a week. Yes. And a lot of drivers that get paid by the mile want that. And I understand that, you know, drivers want miles and they're out making miles. But I think there's other ways, other incentives to pay drivers. We're looking at, you know, we do different types of work. Now not necessarily. He does the nursery type work where he has multiple stops and he pays the drivers for doing other things as well. And, you know, I can't imagine during that season, you know, I do nursery work as well. Can't imagine during that season he's getting those kind of miles, but they pay him other ways. So if they're doing manual labor, they're unloading the racks and so forth, they get paid for that type of work as well. I think there's other ways to pay than just per mile on normal OTR type freight. And I think there's other benefits, you know, fuel economy benefits. Drive slower, don't get as many miles. You'll essentially, especially the way fuel prices are going up, you'll make the carrier more money and I can pay you more to do less. Sounds like a win-win for everybody. All right. All right, we got some calls on Blog Talk. All right, we'll finish this up real quick. And we've got 3 calls here on Blog Talk. I don't know how I overlooked this. We're going to go to Kim. Oops, let's see.
Hi, Kenny. How are you?
Great. How can we help you, Kim?
Hi, Kenny. How are you? Well, when you were talking a while ago about waiting, if you were going to start a new entity or whatever, to wait till after the first of the year in order to do that, because you would have to file a tax return. I am seriously considering in the next, I was planning on maybe doing it before the first of the year, filing for my broker authority. But I know that you have to start a whole different company and have it completely separate from the carrier side. So when you file for your authority, it takes, 21 days or whatever before it becomes active. But because you have to file for the business and with the state and all that kind of stuff and get your trust or your bond in place, that you have to do that beforehand. So if I did that before the first of the year, then that would be considered starting a new business before the end of the year, correct?
Well, what you can do, I would not fill out your application for your authority yet. But what you can do, and you're doing this in Arkansas, I don't know exactly. I've done it.
Yes.
Done it in Iowa and I've done it in Missouri, but I have not done it in Arkansas. What you can do is fill out your paperwork to. Are you going to be an LLC or corporation? Have you figured that out yet?
I haven't, and that was another thing that I'm wondering if I need to make this like a sole proprietorship. Or what is the best option for me when I do that? Okay.
I'm going to come back around to that here in a second. You should either be an LLC or a corporation. Probably an LLC is the better way to go. I'll come back to tell you why.
Okay.
But if you fill out those forms now, you can put the start date of the first of the year. should be able to fill out the forms now and
Okay.
and post date them so that it'll start the first of the year. And there might be a fee or something
Okay.
that you can pay now, and then you probably write that off of your current company taxes. But you can start the business post-dated from now. Most states allow you to do that, up to 30 or 45
Okay.
days. I think maybe 90 days even. And so go ahead and fill that out. Then the paperwork gets processed. Everything's done. First of the year, or I guess first is a holiday. So the second, Tuesday, January 2nd, your business is up and running. Then I would fill out the application for your
Okay.
authority.
Okay.
All right? And
Okay. So then I wouldn't have to file a separate thing because the business didn't actually begin until the 1st of January, correct?
exactly. And then you'd go ahead and you can get your tax
Okay.
ID number and everything on the 1st of January, get everything up and running, then you don't have to worry about it. Because now, if this was mid-November, I'd say go ahead and do it now because you do want to get up and running.
Right.
Unless you have a customer that's just
Right.
biting, chomping on the bit to get started with you, it's probably better to wait.
Uh-huh.
It'll save you. I don't expect that that week or two lead time, especially if it did go active, it'd be right in the middle of the holidays and all that anyway. It probably wouldn't benefit you, but you'll end up having to pay a few $100s for extra to get stuff done. So to me, this time of year is probably better just to wait until after the 1st. All right, now as far as LLC
Okay.
or corporation, if you are driving a truck, okay, you're driving the truck, you own the truck, you drive the truck, you maintain the truck, you dispatch the truck, you everything about the truck, right? Everything is yours.
Mm-hmm.
There, being an LLC or a corporation provides virtually zero protection because they're going to sue everybody involved and you're the only one involved, okay? If you're a fleet and you start hiring other drivers or you bring on owner-operators, whatever, then it's important to incorporate or become an LLC. As I was saying before,
Okay.
becoming an LLC, now when I did it, a corporation was a better way to go at the time. Things were that was in 2011,
Okay.
I think it was. Over the next couple of years, an LLC started to take precedent and take the lead in that. For one of the reasons, New Jersey, Pennsylvania, and so forth don't necessarily recognize it. Other states typically don't recognize an LLC the same way. It's really just a tax thing, and it separates you for that. But other states don't always recognize it. So an LLC, especially for a brokerage where you're only operating within your own state anyway, provides a lot of the same protections and a lot less of the headaches of a corporation. So LLC is probably the way to go.
Okay.
But check with your accountant and possibly
Okay.
an attorney on that. Okay? But that's typically from what I found. Okay?
Okay.
When you're a broker, you're essentially hiring other contractors to do the job for you. If you saw,
Correct.
it was a couple of months ago, JB Hunt, as a broker, hired a carrier, and the carrier, there's virtually zero way for a broker to screen individual drivers. I can pull a report for the carrier. I can see that their authority is active. I can see that their insurance is good, all of that. But if a carrier has 1,000 drivers, I can't do an individual background check and motor vehicle check, everything on individual drivers. It's just not possible. The systems don't exist to do that.
Correct.
I suppose it could, but it would be so
Right.
time consuming that it would be it's not possible. Okay. JB Hunt hired a carrier. The carrier put a driver on the load. The driver got drunk and killed somebody while driving. JB Hunt was sued as a broker, and they said JB Hunt should have done a better job vetting that particular driver. Okay. There's no way for JB Hunt to do that. Cost him, I think the settlement was like $15 million. And I think JB Hunt was responsible for about a third, like $5 or $6 million of that. Okay. So, being incorporated and having that level of separation is super important as a broker or as a carrier with multiple trucks. Sole proprietor, if you're a one truck operation and you're the head cook and bottle washer, that's fine. But once you start growing beyond that, multiple trucks, or you're a broker hiring outside carriers, you have other people that are responsible for doing your work. It's super important to have that legal separation there.
Okay. So it would, and so an LLC would be that would give me protection, or it has to be a corporation.
An LLC
Like
and a
S corp or
corporation,
C corp.
an LLC, and again, I'm not an attorney and I'm not an accountant, but an LLC and a corporation speak to your attorneys and accountants and get their recommendation on this first. But for the most part, they provide essentially the same levels of protection. They separate you from that business. Okay. Now, if you're sued, your company is sued, that you could essentially, if it's $6 million lawsuit, I mean, that'll put you out of business. All right. It'll be sad,
Yes.
but you can close the doors on that brokerage, walk away from it. It'll be sad and you'll be disappointed, but at least you'll still have a house to go home to. Okay. You won't lose everything.
Right.
There is a separation there. It's super important that you talk to an accountant, because the easiest way to pierce that corporate veil is through accounting. Make sure that you keep all your numbers separate.
Okay.
Make sure that, if you have a business credit card, you only use it for business, and vice versa. And keep all of that separate.
Right.
If you, for some reason you do use your personal credit card for business, make sure on the books it shows as like you're loaning the business something, or make sure it's all accounted for properly, because the easiest way in a lawsuit for them to say this is just a tax thing, it doesn't separate you from any liability, is through the accounting, forensic accounting. And if there's a $15 million lawsuit hanging on the line for this, there will be forensic accountants involved doing all the hard work, and they will find all the details about everything that you've done wrong. Okay, so keeping your accounting separate is the most important thing, and but it is important to do that.
Okay. Well, now one other question I have, if you have time, is I have been told that, in fact, I called and talked to the company that Elizabeth had told me about the trust out in California,
Okay, yeah.
and we were talking about it, and he said that that to do the brokerage, I needed to have a completely different address and a completely different phone number for the brokerage than anything to do with the carrier, that had to be completely separate. And that's really hard unless I go get a P.O. box for my brokerage, because I run the truck from the house.
Okay. I went through the same thing, and the more separation you can have, the better, but it's not required. It's not necessary. The insurance company, the reason that you have to have two separate companies is this. It's illegal for a carrier to broker freight. So what happens is, and this is why insurance companies are scared of this, you as a carrier will book a load under your carrier company, okay? As a carrier, you will tell the shipper that I am putting this on my truck. But because you own a brokerage also, you instead hire another truck to come in, all right? But you have two separate companies there. Carriers can't broker freight. So your carrier books it, gives it to a separate company, all right? It doesn't matter if it's your company or not. It could be Joe Blow down the street owns a brokerage. You could have him broker it. It's a separate company, and now that company is brokering it. But the carrier brokered it to your other brokerage. So you're double brokering. That's the definition of double brokering, which is completely illegal.
Correct.
For a lot of reasons.
Exactly.
It's illegal because whose insurance covers what? How does the money trail work? If somebody's at fault, where does the fault lie? Where are the liabilities? There's a legal issue there, okay? Insurance companies are afraid that will happen. That being said, if you explain it to them, most of them understand. I have the same situation. My brokerage and carrier are in the same house. My insurance company said, it might be a good idea in the future if I'm the only name on my, officer listed on the carrier side, and then Elizabeth is the only one on the broker side, or so forth. Keep a separation there. Maybe we have the one at my house address and one at my office address to keep separation. But right now it's all together and it's not a problem. Technically, the law doesn't say that you have to have a separate company. You do have to have. It does say you have to have separate authority now. It didn't used to be that way until MAP 21. A carrier could have both carrier and broker authority. After MAP 21, the carrier has to have separate authorities, but they don't have to necessarily be separate companies. So You know, it's a little bit, the more separation you have, the better it is to convince the insurance companies that you won't be doing anything illegal. But as long as you explain it to them, most of them understand. And I've had the same issue of trying to explain that same situation to customers, because I'm trying to, you know, work with customers that I've worked with before on the carrier side, and they say, well, I'm not putting it on my truck this time. I'm going to broker a truck for this. And, you know, I have to explain that to them. You'll run into situations where you have to explain yourself, but it doesn't, you know, make that big of a difference yet. And most insurance companies are starting to understand that it happens, you know, and so I wouldn't worry about it until it becomes a problem.
Okay. All right.
That being said,
like I
said, being said, talk to your insurance agent about it. Don't worry about what the guy at the trust fund holding company or whatever it was. Don't worry about that. Talk to your insurance company. That's the only time you'll have a problem. See what they say.
Okay. Okay. Well, we have our insurance through OOIDA right now, but that's subject to change in April. So
talk to them about it.
And also,
I will say OOIDA are not necessarily broker friendly. Ask what they think about it as an insurance company. See what they say.
Okay. And then also, and I'm sorry, I'm running over.
Last question. That's it. Cutting you off after this one.
Okay. Is Elizabeth and I had actually talked about this as well, is instead of to run everything, and my one direct shipper that I've already talked to about letting me broker freight for them, talking about running everything, every load through the brokerage and then brokering that to my truck. Which is the best way to do that? Just keep doing the carrier the way I'm doing it now and then just use the brokerage for other things? Or does that throw up red flags when you run everything through the brokerage?
It should, for simplicity, it should all go through the brokerage, because unless it goes through the brokerage, you can't broker it out. So you could either do one of two things. You can run everything through the brokerage and make it simple. Your customer has to write one check. They know everything goes to the brokerage. Or you have to have the customer, you know, basically negotiate two separate contracts and make sure that if you put it on your own truck and it's the carrier goes direct through, you know, direct to the customer, that they pay the carrier directly. All right. You don't want to have them pay the broker and vice versa. Absolutely under no circumstances do you want them to pay the carrier and then broker it out, because that would be double brokering, and that's where the problem is. And again, it's all about the flow of money for this. All right, so you're safe if everything goes through the brokerage first. That being said, the brokerage, in the beginning, you probably won't have much, if any, expenses. Eventually, you're going to have to get insurance on the brokerage. Your insurance is going to have a cost. Mm-hmm. So whatever, you know, the brokerage is going to have its own set of expenses in addition to what your carrier has.
Correct.
Your insurance is probably going to be based on the volume that you do on the broker side, which means if everything goes through the broker side first, you're paying double insurance. You're paying for the broker's insurance and you're paying for the carrier's insurance for that same load. So it gets more expensive. You lose a little money doing it that way. Okay. And if in the future you decide that you want to factor, I don't know if you factor on the carrier side, but if you end up factoring on the broker side, you end up, you know, brokering, you know, factoring essentially could be more expensive too. So it gets to be tricky. So just be careful, because you end up double dipping in expenses. So the best situation is anything that you put on your truck goes direct through the carrier and anything else goes through the broker, but it might be more difficult for the customer. So it might be easier to just book everything through the brokerage and then put it on whatever truck you want. That make sense?
Okay. Yes.
All right.
It does. I'm sorry I took so much time.
Okay.
It's
all
just scary to pull the trigger.
Oh, I know, but you know, it's fear is, you know, usually what happens before the thrill of your life. So don't worry about it. All right. So I'm going to go ahead and put you back on hold. I appreciate the call, Kim. 2 more calls and we'll wrap things up. We will go to Jason. Welcome to the show, Jason. You have something to say about 179 deduction.
Yeah, want some clarification on it.
Okay.
Did you say that if you had a $50,000 piece of equipment and you used the 179 deduction, you have to use the whole $50,000 for the 179? You don't have any carryover?
For 179, yes. Well, and now I want to add to that. I'm not an accountant, okay? It's my understanding that it's all or nothing. You can't take it over multiple years. If you put it on a 179, you take it all.
Okay. All right, that's what we're going to have to figure out what to do, because obviously my income is going to be better next year than this year.
Right. And so you could do what I would recommend is do the double down depreciation method, to where you'll take more upfront than later on. But again, it comes down to what your situation is. So it might be better for you to just do an equal depreciation and take it as time goes on, because you might appreciate. What's a better word? Appreciate, when you're talking about accounting, is not a good word for describing an emotion. You might like the deduction to be bigger later, so you could just do a straight line depreciation.
Yeah. Okay, that was the one question I had.
Well, didn't you have something about household expenses?
Oh yeah. Just when I talk to a lot of these people out here, and if they do have a salary figured in their fixed cost,
right,
it's an arbitrary number that they pulled out of the air, and they have not took into account that salary is supposed to pay their household expenses. And when you're looking at your cost, you got to be able to keep the lights on and keep everything going at the house when you're looking at quoting a lane or a rate.
I agree with that to a point. The other thing I would say is you have to live within your means as well. Okay, so if every other company out here, if they're earning 50 cents per mile, just because you become an owner operator doesn't mean you're going to make $1 a mile profit, that you can take to the house. So you can't calculate everything you have at the house and say this is what I need to make, because if you live in a multi-million-dollar mansion and you have a $6,000 a month electric bill and you drive a Rolls Royce, chances are you're not going to be able to hit your rate. You see what I mean? So you have to live within your means as well. But you're right, your number has to pay your expenses at home, but there's a balance. Remember, I mean, if you went and got a job for another carrier, what does that carrier pay? Could you survive on that? And ideally, you would want to structure your household expenses around what you would make at a normal job, if you were working for somebody else. And then the fact that you own the business, everything else, could be going into savings, going into investments, going into other things. Because if you live week to week and your whole payroll is based on just paying household expenses, it could be risky. And I know you have a better handle on your numbers than most. That's why I'm kind of breaking it down a little different. But there are a lot of people out there. The majority live paycheck to paycheck, and they don't make enough to put any money aside. They don't make enough to have a maintenance fund. They don't make enough to save anything. They don't make enough for retirement. My dad was a big union guy, and he's retired now, and he gets a pretty nice set of retirement check every month. He gets his check, right? And he talks about, see, if you were had a union job, you'd get your retirement and you'd get your pension, and this would be it. I said, Dad, look, do you think that you didn't already earn that money? You earned it over that almost 40 years you worked. But the company put that money aside and invested it for you. And now they're paying it back from the investments, right? You already earned that money. So as an owner operator, you own your own company. You have to be smart enough to manage your money and take that extra you earn as the business owner and put it away for savings and invest it and buy, assets that you can, turn into retirement later. Most owner operators struggle with that. Most small business owners struggle with that. Most small business owners end up working their whole life right up until the day they die, because they don't plan for retirement, unfortunately. And right now,
right,
the baby boomer generation, and they're into retirement and moving into retirement, and they're laughing at some of us that the unions and the retirement type jobs are going away. So you have to be smarter to do it on your own now. unfortunately, Americans are arrogant and ignorant, unfortunately, and it's not
90
happening.
seconds.
Yeah. Yeah, and I mean, the same thing goes too with there's a lot of guys out here that they're only out here so that they can say they own the truck, and instead of having the big house, they've got the big truck payment. That's all they have to show for it.
Absolutely. Absolutely. So that being said, we are at the top of the hour. I've got one more call, Jason. I appreciate you joining us tonight. 2 hours and still
60
going strong.
seconds.
Those of you that are listening, the phone lines are about to close. I've got one more call. If you're on the line, the lines will stay open if you're already on, but you won't be able to call in after this. Phone lines are closing, but we will go to Wesley in Oklahoma. Wesley, welcome to the show. Great. How can we help you?
Thank you. Yes, I want to know about, this is a three-part question. One is a salary-based trucking that I've been listening to two guys on YouTube, and they work for RST.
Right.
They're a contract through Prime, and they get salary 50. Well, they start off at 50
10
a year,
seconds.
and then I get paid cents, like 40 cents a mile, and then you got percentage. Tell me what's the best way to go? Is companies going to get rid of cents per mile, or are they going to go percentage or salary?
I don't see the cents per mile thing going away anytime soon. I know what you're talking about, RST, and they pay $1,000 a week, essentially $50,000 a year, and that's the starting pay. Now, the way they came up with that is the average drivers out here that are earning their 38 to 45 cents a mile, depending on how many miles they drive and everything. The average, they're only making about $45,000 a year. So when these guys get in these trucks and they go sit at a dock, and it could be stressful when you get paid by the mile and you get stuck sitting at a dock all day long, and you're pounding your head on the wheel because you're not going to make enough money to pay your bills at the end of the week. That's why that $1,000 a week program works. And a lot of people poo-poo on that because, granted, if you're making 50 cents a mile, you could easily make more than $1,000 a week. But forget, when those drivers go home at the end of the week, and they maybe take a week off in the middle of the summer or whatnot, they still get a paycheck. They get consistent money year-round. They can budget for that. That's one of the hardest things that truck drivers have is budgeting. So that's why that program has taken off. That being said,
now, what about they get paid every 2 weeks? What about that deal?
Well, I mean, that's all just part of the agreement that they have. Whether it's 1 week or 2 weeks, it's still the same amount of money that you're bringing home. So there's a lot of companies that pay every 2 weeks instead of every week. I know. I mean, that really all comes down to what your agreement is with the employer. So I don't have a problem with that. I mean, either way, that's just what you'd have to know that going in before you sign on. But if government employees typically get paid every 2 weeks. They get paid well, but it's every 2 weeks. A lot of factories pay every 2 weeks. I mean, getting paid every 2 weeks is not uncommon. And it's one of the reasons that they can pay and they keep all those guys in fairly new equipment and everything is because they have to keep their expenses down. Running payroll and keeping an accountant on staff all the time, it gets expensive. So that's one way to keep that cost down is to just do it every 2 weeks. So I don't know their operation, but I can see, the benefits of some of that. That being said,
you're saying, is that why RST is taking off, because they're getting paid salary?
Well, I will say that you follow those guys on YouTube, and the guys on YouTube that you follow, I follow them also, and they have both gotten away from that program, and they're both leasing their trucks now. So they're owner-operators now, or lease operators.
Correct.
So
correct.
So now they feel that they're earning more money because they're responsible for all their expenses. They're responsible for their insurance payments. They're responsible for their truck payments. But they've got skin in the game. Okay. Now they get paid a percentage, or they get paid, I guess it's like a flat fee. But essentially, if you break it all out, it equivalent, to what a percentage, might be. So But again, they take a week off. They still have to pay those percentages versus, you know, I don't like any company. You know, at my company, Patriot Start, we pay for the insurance and things like that. We don't have like a weekly deduction that comes out for things that they're not responsible for because they don't have any control over the cost of insurance, and that's the biggest cost that they have, and their truck payment, of course. Now, if somebody was, and I think let me start this by saying I think RST's operation is awesome. I like the program they have. I like the way their trucks are set up. I like the way that they're doing everything. Keeping drivers happy is, you know, that is awesome. You know, I think it's super important. There's not a lot of companies out here that try to go out of their way to keep drivers happy. So that says a lot. You know, I don't know any of those guys personally.
So percentage is the way to go?
Percentage, I think percentage is the way to go because you have more control over it. As long as you have the option to dispatch yourself. Now, they're owner-operators, and they have the right to say no, but they have basically a dispatcher. You know, and having the ability to pick and choose loads if you have percentage and have skin in the game, I think could lead to more money in your pocket. So I like the now there's nothing wrong with salary. Now, at what level, if you're looking at going over there, at what level are you looking at going in at? As a company driver where you get $1,000 a week, or do you want to lease a truck, or I mean, what are you really looking at?
Well, I'm still company right now. I'm driving for a different company, but I was thinking going with a company that pays percentage. I think I'll make more money doing that way.
Possibly.
That's my opinion.
I agree. Right now, rates are really good. Okay, and if you have some say in what the rates are, the problem with percentage is, if they put you on a percentage run and then they put you on something dedicated where your percentage is, 50% of zero is still zero. Doesn't matter what your percentage is. You got to make sure you're making money to take a percentage of. You see what I mean? Now, the benefit to those guys on salary, it doesn't matter how much that truck makes or doesn't make. They're still bringing home a paycheck. That's why they like that. So there is something to say for that. With rates as good as they are right now, I do agree that I think right now would be great to be on a percentage basis. Over the past 2 years, however, percentage could have been very tricky. I mean, you may have had a hard time making ends meet on percentage because rates have not been phenomenal. Right now, rates are great, and if you can capitalize off of that, that's awesome. So just make sure that you're putting away for a rainy day.
Well, yeah, that's why I like your company, because don't you pay percentage?
Yeah, I do. I pay percentage. Now, I only work with owner-operators right now. But that being said, after the first of the year, we're looking at different opportunities too. So, I do pay percentage, and I've looked at the salary payment plan, and I may offer something like that. I haven't quite figured out what the number would be yet. I don't know that $1,000, to me, I think that seems on the low side, but I'd have to run the numbers and really, put pen to paper and figure that out.
Okay.
I don't know that I would want to pay a company driver on salary unless they had control over what they did. Because, if you're on salary, and I'm just, for complete transparency, if I put you on a salary position, but then for some reason I have to send you to take care of my customers, I have to send you somewhere where you're not going to make a lot of money, you won't be happy. On a percentage position. Versus if I keep you on salary, you don't care what you do or where you go. Or even for that matter, on a mileage basis. You don't care what you do and where you go as long as you make make the miles. Right? I like the salary idea because, as I was saying before, I don't like anything based on a rate per mile or anything because, there's more to it than that. If I was paying you on a rate per mile, you'd want me to give you that 3,500 miles a week. Versus if I give you, a flat salary, you'd be happy if I found, runs that are 200-300 miles a day and you can kick back and watch TV the rest of the day, which in a lot of cases.
Well, see,
Go ahead.
That's why I like salary, because you're not stressed out. I got to make the miles because, when I go home for home time, I'm not going to get a paycheck. That's why I like salary. But another thing about percentage, you got to set, I guess, both salary and percentage. You got to set income coming in.
Yeah, well, and percentage, you don't necessarily have a set income coming in. The only way you have a set income, honestly, is on a salary. Percentage or mileage base, if the rates drop and you're on percentage, you take the hit. The downside of a percentage is, let's say I pay you 30% or whatever the number is, and you're just killing it for the next year. 2019 comes around and rates drop. You don't like that. Now you want to switch over to salary. Well, I took the hit and I paid you, more because you were on percentage that whole time. Now that rates drop, you don't like that. You want to, switch jobs or, go on to a different pay structure and so forth. It gets difficult when you offer different systems like that. And there's always going to be different systems because there's different companies out there. And, we're in an industry where 100+% turnover is, it's the norm. So people are always looking for the next best thing. So again, these guys that are on the salary, they're keeping them happy. They're giving them nice trucks. They're on salary. I look at that and, I don't necessarily want the nicest truck. I'd rather have more money in my pocket. But these guys are away from home a long time and they like the nicer truck. They like, the consistency of what they're doing. There's a lot to be said for that. I have some runs where my guys are on, they're on percentage, but I have them on a dedicated run. Well, they like it because it's consistent. Mainly because it's consistent. So they know how much money they're making. They know they could possibly make more going out on the spot market and doing different things. Rates are going up. They could kill it on the spot market right now. But what I have them on now is consistent, and they like that. There's a lot to be said for consistency.
Yeah, that's what I like too. Yeah. Well, I appreciate it, and thank you for taking your time, and thank you for answering the questions. Thank you.
You're welcome. And before you make a switch to another company, I'll leave you with this. Interview the company. When a lot of people go to a job and they think that they're going there for the company to interview them, hoping, crossing their fingers that they get the job. Right now, truck drivers are in high demand. You have the opportunity to interview the company. Make sure the company is the right fit for you. Make sure you understand how you get paid. Make sure you understand, how much you could make, what your different opportunities are. And, you could go to anyone. It doesn't have to be, it could be me, it could be RST, it could be any of these other companies out here. The way they're paying, whatever fits you the best. If you're the type of person that likes to live in the truck and get those 3,200 miles a week, then a per mile rate is for you. But if you're like the kind of guy that doesn't mind, kind of being the problem solver and, being a little more hands-on with something, then maybe a salary position is better for you. Versus if you're the type of guy that wants to hustle and, get the greatest rates no matter what it takes, then percentages for you. So there's different strokes for different folks. And there's a lot of different opportunities out there. Even RST is the one you were talking about. They've got the option to do the salary, or they've got the option to lease the trucks now. Then they've got owner-operators underneath them that are taking on company drivers as well. So you've got different levels that you can go, and every company out there has got a different solution for you. So that being said, holy cow, I can't believe we went 2 hours and 15 minutes long. This is insane to me. So I'm going to wrap things up. I don't think I've done a show this long in forever. So thank you guys, everybody, for sticking with me for so long. Thank you all on Blog Talk. Thank you all on YouTube. Thank you all on Facebook. I know there's more questions and comments. I'm going to scroll through all this and try to answer as many questions as I can after the show. And to clarify one thing, so just to confirm, you cannot broker to your own motor carrier. I'm just starting my own business with a partner, getting our own authority, etc., but eventually we'll learn to broker. You can broker to your own carrier, but you cannot broker to your own brokerage from your carrier. The carrier side of your business cannot broker freight out. So if you book a load with a truck or with a shipper, you tell them that you're putting it on your own truck. You have to put it on your own truck. You cannot put it on somebody else's truck, because as a broker, or I don't want to get my terminology, it's getting late. As a carrier, you cannot broker freight, even if you give it to your own brokerage, because essentially your carrier brokers it to your brokerage and your broker brokers it to another carrier. That's double brokering, which is illegal. David asks, is the syncing done? We were talking about the TMS systems. We were talking about syncing them up with the different software in QuickBooks. Syncing is super easy. Different software does it different ways, but most of the time it's just a matter of hitting the button that says sync, and then it does all its processing and it's done. There was one program I was using that every time that you closed out a load, you finalized the load, printed the invoice and so forth, it automatically on its own synced up to QuickBooks. Mystic, the one I'm using now, what we do is we go in there every week or every month, and you got to hit the button and it syncs up any load that's not already synced. It'll upload those, but it's pretty easy. All right. Tons of info. Well, tons of time. I don't usually go 2 hours long. It's crazy. And then somebody said you need to sit down, break down each pay group. In most cases, the percentage and percent per mile equal out when you know the rates, lanes, and history of the money, which companies should know pretty quickly. And honestly, I see the same thing with drivers that are on a salary. Typically, the salary is based on what the average driver would make in another operation. Cost cents per mile is usually based on about that. The percentage is usually you're in a ballpark of all the same. There's different incentives to each one. So if you're making salary, you want the highest possible rates you can get. Doesn't matter if it's long miles or short miles. You want the most money you can get in that period of time. If you're on if you were on percentage. If you were on a salary, then you're willing to do whatever it takes, even if it requires a lot of sitting around, reefer operations, a lot of sitting at the docks, that type of thing. And then if you're on a cents per mile, you want coast to coast, as many miles as you can possibly get. So depending on what the operation is, but it all usually equals out to about the same thing. And the same goes if you're an owner operator leasing onto a carrier. There's one carrier out there, they charge 2.5%. Okay, that's what the carrier takes. Then they charge $250 a week on top of that for their admin fees. Then they back charge for the license plates, IFTA, insurance, every little nickel and dime thing, everything possible. Essentially, you put their name on the door to run under your own authority. You even have to do your own billing. Okay? At the end of the week, with all the time and everything else you have invested and everything else that you paid out, you end up about the same as somebody that might do 10% and not back charge for all that. Or in my case, I do an 80-20 split, but I cover the cost of the insurance. Now, if one of my drivers, and this happened to me last year, I had some claims. And if one driver has an accident or has a claim or so forth, it can cause the insurance rates to go up across the board. Not just for the one driver or the one truck, but for everybody. So the driver that's just, going about their business, has the perfect driving record, never gets a speeding ticket, always driving nice and slow and safe, everything great. But then upon insurance renewal, their insurance cost doubles because somebody else screwed up. It's not fair to them. That's why I think it's more fair to the owner-operators if the carrier provides the insurance and pays for the insurance. That's my opinion on that. And there have in the past been court cases where the owner-operators have taken the carriers to court because they were back charging for that. Because in the truth in leasing laws and FMCSA, the carrier cannot force the owner-operator to buy something they can't get on their own. At the same time, it says they can't. It says they can't force the owner-operator to buy something through them. They should be able to get it directly. But at the same time, requires the carrier to provide the insurance. The owner-operator must be on the carrier's insurance. The loophole there is you have to pay for the insurance one way or the other. So I think the carrier, it's better if the carrier pays for the insurance out of the percentage. So yes, my percentage is a little higher. Again, others out there are paying 10%, 15%, whatever. I do 20%, but I pay for a lot more things, and I provide more support, and I provide a load board, and I provide different things that other carriers don't provide. At the end of the day, if you look at my operation, where I'm doing an 80-20 versus another one that might be 85-15 versus another that's 90-10, at the end of the day, by the time all the expenses get passed around and everything else, it probably, it works out to be about the same. Now there's different opportunities that might arise, different, customers that you might deal with. Those types of things are more likely to give you the advantage. A lot of people came over to work with me because of me helping them to get their own authority and that type of thing. I try to help them learn how to run their business under me. I try to be as transparent with everything we do as possible. And I even tell them, when the time comes, I'll help you fill out the paperwork to get your authority. So people come to help, work under me for that reason. And, that's what they're looking for, versus other carriers may not do that type of thing. So there's other benefits that get passed around. The percentage and the money, at the end of the day, it's probably in the same ballpark, no matter what your percentage is, because they back charge different or whatnot. That's just what I have found. So, all right. I can't go any longer, guys. 2 hours and 20 minutes. I can't even believe I went 2 hours and 20 minutes. Is Ascend public? Ascend is public. It's the free TMS. They actually... their basic version is absolutely free. thefreetms.com. I don't get a kickback. They're not a sponsor. There's no financial incentive here. thefreetms.com. And, you can try it out. Maybe I'll see if I can work something out with them to where I can, somehow co-promote them or something with DAT, because DAT is also helping us out. So, okay, everyone. I will say one last feature about Ascend, which I think is cool, talking about DAT. Once you put all your load information in, Ascend, the software, knows where your trucks will be. And since the software knows where your trucks will be, it syncs up with DAT and says, here's some load suggestions for you. It's kind of cool. Cool little feature. And then on the broker side, I said it's even better for brokers. It automatically posts all your loads to DAT. So you put all your load information, saves a lot of double entry, that type of thing, which is a whole other show topic. That's why a lot of times you'll see loads posted that don't necessarily exist. It's because you've got software doing it for them. Anyway, okay, guys. Whew. 9:20. I can't even believe it. I know Jason Pote says the Truckers Coach Show will be going live here shortly. I don't know. I think he said 9:45 or 9:30. So everybody stick around and check out the Truckers Coach Show. And that is it for me tonight. This has been the Trucking with Authority Show. I've been your host, Kenny Long. Remember to always dream big. Don't be restricted. There's nothing that can hold you back. And aim high, because the only thing that stands in the way of you and your goals is yourself. So aim as high as possible. Strategize your plan, because everything changes. Always have a strong plan. Write your business plan. Have a backup plan. Be ready to change on the fly. Adapt and overcome. Strategize your plan. Earn your success, because you don't deserve anything. Nobody deserves anything. Contrary to what our politicians might say or what anybody else might say, nobody deserves anything from anybody. You have to get out there and earn it. So earn your success. And remember that only you drive you. Have a good night, everybody.